Welcome to video 3 of part 1 of the EA Tax Training Enrolled Agent Exam Preparation course. Tom here, back with you to discuss capital gains. There's a lot of material in this video, and some of the concepts will also be applicable in part 2, business taxation. So watch it as many times as you need to and study the slides and the free resources. Specifically, what we will cover in this video are types of property, basis of assets, capital gains and losses, and non-taxable and other sales. As far as our progression through the tax return here, we are still at the top talking about gross income. So capital gains and sales of other types of assets are included in gross income. As we've seen before, there are free resources from irs.gov. At the top, we've got the publication 17 that you've seen in the prior videos. We've also got instructions for Forms 1040 and 1040 SR. What we are adding for this video, these next 4 items are ones that you will want to get and read through. Schedule D and the instructions for Schedule D. So this is where capital gains and losses are actually reported on your tax return. And then Form 8949, sales and other dispositions of capital assets, and the instructions for that form. Again, many of your sales will be reported on Form 8949, and then those flow into Schedule D. So we will look at those forms in this video, but you are going to want to read through those, read the instructions, and much of the material from this video is covered in the instructions to those 2 forms. And then you do see a few other publications that we have listed here as well. So if you want even more information, you can dive into those to get a more in-depth understanding of the topics. So let's start by talking about types of property. In the Internal Revenue Code and in the various IRS publications and form instructions, they will mention types of property, and they will kind of assume that you know what they mean when they're talking about those. So I want to make sure that we all understand when you see a word of a type of property or type of asset that you know what it means. So first, investment property. So this is property that produces investment income. So this is things like stocks, bonds, treasury bills, and notes, those types of assets. Then there's business property, and that's property used in a trade or business. So think about buildings, computers, equipment, trucks, machinery. So any business property, you think of a business that you know of, a retail store that you go into or an office that you go into and look around. Any of the property you see in there would be considered business property. Then there's intangible property and its opposite, which is tangible property. But intangible property is property that is not physical in nature. So this is things like computer software, patents, trademarks, licenses, customer lists, things like that. And its opposite is tangible property, which is physical property that can be touched. So think about a computer. So the computer itself is physical property, but the software that runs on the computer would be considered intangible property. So tangible and intangible property. Next is depreciable property, and this is property that is subject to depreciation expense. Now, depreciation expense is primarily actually a business concept, and we'll talk more about it in part 2. But there is oftentimes overlap between part 1, individual taxation, and part 2, business taxation. And so it is important that we understand it now, because we will talk about depreciation as far as individual taxation goes. So let's understand a little bit about what depreciation is. The most common description of depreciation you'll hear and that you probably think about is that assets lose value over time due to wear and tear. And we're talking about tangible assets here. So if you've all heard of this concept that if you buy a new car, as soon as you drive the car off the lot, you've lost X percentage of the value of that car because it depreciates immediately when you drive it off the lot. And then over time, obviously that car, you use it, You drive it, there's going to be wear and tear, and that car is going to, quote unquote, wear out. And eventually, that's going to end up in the junkyard. Nobody's going to even be driving that car anymore. So depreciation expense, one way to think about it is that you are accounting for that loss in value over time due to wear and tear. The other way to think about depreciation expense is it is the way that you are deducting the cost of that asset. So when you buy, let's say you buy a small thing like office supplies, you buy pens and paper and notepads, things like that for your office. Well, when you buy those, technically that is an asset. But the tax code assumes that those small type of items, that you're going to use them up within 1 year. So rather than depreciating those, you simply expense them. You take a deduction for them for a business. We're talking about a business expense here. You take a deduction for them in the year that you buy them. Now, we all know we've all got drawers full of old pens and notepads, so they may not actually be used up within 1 year, but that's the assumption because they're small things that tend to get used very quickly. So you expense them or you deduct them for your business in the year that you buy them. But what about larger items? What if you buy a van for your business to make deliveries? Well, hopefully that van is going to last more than 1 year. It might last 3, 4, 5, or even more years. So what depreciation expense does is instead of taking the deduction for that van all in the year that you buy it, you're going to take part of the deduction each year that you expect to be able to use that van. And in the tax law, it's not even what you expect to be able to use that van. The IRS actually has a list of types of assets and how many years those assets are expected to last. And so you deduct the cost of that van over that number of years. So instead of taking the deduction all in the year you buy it, you're taking part of the deduction in the year you buy it, part the next year, part the next year, part the next year, etc., until that useful life ends. So that's what depreciation expense is. And again, it is a business tax concept. So examples of the types of assets that can be depreciated are buildings, machinery and equipment, computers, vehicles, furniture, etc. One main exception to this is land, because it is considered that land is not going to wear out over time. Now, we can talk about erosion and all of that, but for purposes of the tax law, they say, hey, the land is there now. It's going to be there 5 years from now, 10 years from now, 100 years from now. So you don't get to take depreciation expense for land. So that is the concept of depreciable property. And again, we'll go into all the details of that when we talk about those concepts in part 2, business taxation. Next types of property are real property and personal property. These are very old terms that have been around for a long time. So real property, think of real estate. Real estate is real property. So it's land, buildings, and the equipment and fixtures that are attached to the land and buildings. So example, air conditioning systems, electrical systems, plumbing, anything that's kind of built in to the building or attached to the land would be considered real property. That is opposed to personal property. So personal property, you can think of it as this is the property that you could move. You could pick it up and move it. Even if you can't personally pick it up, maybe you could pick it up if you had a machine or of some sort. So it's personal property, and it is everything that's not real property that's tangible. So you think of in a house, if you have a house, you have the house itself and all the systems like air conditioning, electrical, that's all real estate. The land that the house is sitting on is also real estate. It's real property, but everything in the house, so the furniture, the paintings that are on the walls, the clothes that the people who live there have, the exercise equipment that they have in the house. Anything that's in the house that's not part of the house or the land would be considered personal property. In a business, just again, think about when you go into a business, you see chairs and desks and shelving and racks in a retail setting. If you're in an office and you've got cubicles, you've got those dividers between the cubicles. That's all personal property. Things in a warehouse like forklifts that you might have and shelving, that's all personal property. So that's the distinction between personal and real property. You will hear those terms a lot, especially in business tax. So you want to make sure you know the difference between the two. Next is capital versus non-capital assets. So this video is titled Capital Gains. So this is obviously an important concept. So first, non-capital assets. There are specific categories of assets that are listed by the IRS that do not result in a capital gain or loss upon their sale or disposal. Instead, that gain or loss is considered to be an ordinary gain or loss. So a non-capital asset is any asset that is on that list as being not a capital asset. Everything else is a capital asset. So any asset that's not considered non-capital is a capital asset, and it results in a capital gain or loss upon sale or disposal. Why is this important? Because capital gains, long-term capital gains, are taxed at a lower tax rate than ordinary gains and other ordinary income. So if you have income from your salary, for instance, that is taxed at just regular tax rates, what we call ordinary tax rates. That is ordinary income. Long-term capital gains are taxed at a lower tax rate. It's a capital gains tax rate. Capital losses, on the other hand, are limited, while ordinary losses are not. So if you sell a capital asset at a loss, the amount that you can deduct in any 1 year is limited, and we'll go into all the limits later. But if you sell an ordinary asset at a loss, then the ordinary losses are not limited. Again, this is primarily a business concept and also an investment concept. So when we're talking about your personal tax return, we're going to be talking mostly about investment assets, and we'll get into all of that again later. But for now, just know capital losses are limited, ordinary losses are not limited. Therefore, as you can see, capital gains are taxed at a lower tax rate. So we like capital gains. Capital losses are limited. Ordinary losses are not limited. Therefore, we like ordinary losses. If we're going to have a loss, we would prefer that it be an ordinary loss. So in general, taxpayers prefer capital gains and ordinary losses. And this will all make more sense as we work through the rest of the material. So what is this list of assets that are not capital assets? So here it is. Any asset is a capital asset unless it is one of the following: property held for sale to customers, otherwise known as inventory. So inventory is not a capital asset. Depreciable property that is used in a trade or business, not a capital asset. Real property used in a trade or business, not a capital asset. And that is a separate category because remember, land, which is one type of real property, land is not depreciable, so it would not be included in that previous category. So it's all broken out here that any type of real property, whether it's depreciable or not, that's used in a trade or business is not a capital asset. Next, intellectual property. This is like patents, copyrights, secret formulas. that are held by the person who created them or who received it, such as a gift from a person, that would not be a capital asset. So you've probably heard in the news about some of these big music stars and rock stars who are selling their catalog of songs. So they have written all of these songs, made all this music. This is their intellectual property. They, as the creators of it, that asset is not a capital asset in their hands. So when they go out and sell their catalog of music for tens of millions or hundreds of millions of dollars, that is all ordinary income. It is an ordinary gain because it is not a capital gain, because it is not a capital asset. Okay. Next on the list is accounts receivable in a business. So this is the amount that customers owe a business. That's accounts receivable, not capital asset. Certain U.S. government publications, this is kind of the oddball on the list, and you don't need to worry about which government publications for purposes of the exam. Just know it's on the list. Certain U.S. government publications, not a capital asset. Certain commodities, derivative instruments that are held by dealers, and we'll go in later and we'll talk about what a dealer means. But think of this, it's kind of like inventory. If you are a dealer in different investments, then the investments are inventory for you. And so this is saying that these commodities, derivative instruments that are held by these dealers are not capital assets. Hedging transactions is another investment concept. If you've got those, it's not a capital asset. And supplies used in a trade or business, not a capital asset. So if you think about this, the common theme for most of the items on this list is that they are used in a business. If you've got an asset that's used in a business, whether it's inventory held for sale, whether it's depreciable property used in that business, whether it's real property, whether it's supplies in that business, accounts receivable that's used in a business, most likely not a capital asset. And then you've got a couple of investment concepts that are on here, as well as those U.S. government publications. So what this means is that most assets are capital assets, because if it's anything that's not on that list, it's a capital asset. So almost everything you own as an individual is a capital asset. Your home, your cars, your furniture, your clothing, investments, etc. The other thing to notice about this list is it's not so much about the type of asset in most of these cases. It is how that asset is used. So think about, for instance, real property. Your house, if you own a house, that is real property. But if you own it as an individual and that's where you live, it's a capital asset. But if you take that same house and you use it in a trade or business, well, all of a sudden it's on this list and it's not a capital asset. Same way with a car. Your car that you just drive around as an individual person is a capital asset. But if instead your business were to buy and use that car, now it's not a capital asset. So it's not necessarily the asset itself, what kind of asset it is, that makes it capital or not. It is how that asset is used. Since most of the assets in the world are not used in a trade or business or on that other list, most of the assets are capital assets. Moving on, and we're going to get more into capital gains and losses later. That's just to distinguish the capital from the non-capital assets. So now we're going to move on to another very important concept, which is the basis of assets. Asset basis is sometimes called the cost basis. And we need this to determine several things. First, to determine if there's a gain or a loss when that asset is sold or otherwise disposed of. Secondly, to determine depreciation if there is depreciation expense allowed for that asset. Next, to determine the amount to put on a business's balance sheet. So when you have a business asset, you're going to have something called a balance sheet, which we'll talk about in part 2. And you need to know the amount to put on the balance sheet for any particular asset. And what we use for that is it's that asset's basis. And then there are other miscellaneous uses for which we need basis. So when we say basis or cost basis, what do we mean? This is essentially, think of it as the amount of money that has been invested in that asset. So if you buy an asset, if you buy a treadmill to use at your house and you pay $1,000 for that treadmill, your basis in the treadmill is $1,000 because that's how much you paid for it. So that's the simple example, is that the asset's basis is its cost, but it can get more complicated than that. So let's talk about determining the gain or loss on the sale of an asset. It's a very simple concept. You simply subtract your basis or your cost from the amount of the sales price. And that's why it says here, in the simplest cases, your basis is equal to your cost, how much you paid for the asset. So, for example, you bought 20 shares of stock in XYZ Corporation for $500 or $25 per share on June 1st, 2021. On June 1st, 2023, you sold 10 of those shares for $300, which is $30 per share. You have a long-term capital gain of $50, 10 shares at $5 per share. So you bought the shares, $25 each. You sold them for $30 each. That's $5 per share profit that you had. And so you sold 10 shares, so that's $50 of gain on the sale of that stock. So you simply compare the sales price to your basis in order to determine that gain or loss. So when we talk about cost, what do we mean? Well, cost includes not only how much you paid for the asset, but also the expenses of that sale. So commissions, fees, closing costs, sales tax, etc., get added to the basis of that asset. So, example, you buy 100 shares of stock in XYZ Corporation at $10 per share. You incur brokerage fees of $20. Your basis in the stock is $1,020 or $10.20 per share. Because when you actually go out and buy stock on the stock market, you're not just paying whatever the price that's listed on the exchange is. You're also going to be paying some sort of expenses or fees in order to buy that stock. Those expenses or fees get added into the basis, as you see here. So you bought the stock for $10, but your basis is actually $10.20 because you had to pay those brokerage fees. Example 2, you buy a car for $20,000, you pay sales tax of $1,400, a delivery fee of $400, and a dealer administrative fee of $200. Now your basis in that car is $22,000. Even though if you looked on the sticker, it would say $20,000, your basis is $22,000. Specifically, when we talk about real property, there's almost always going to be other costs that are added to the purchase price to come up with your basis. And when you buy real property, there's going to be a document called a closing statement. If you've ever bought a house, you'll know what I'm talking about here. There's going to be all kinds of different costs listed on there. There's going to be recording fees, appraisal fees, abstract fees, survey fees, etc., that are on that closing statement and get included in your basis or your cost basis of that real estate. Now, one category of expenses that do not get included in the basis is loan fees and loan points. So you might get a loan in order to buy a piece of real property, but the loan and the real property are different. They're two separate things. So we don't include those loan fees and points in the basis of the asset itself. If you are constructing rather than buying a building, then all the expenses of construction are included, including materials, labor, permit fees, inspection fees, etc. If demolition is done prior to building, so in other words, there's already something on the land and you're going to tear it down before you build your new building, then those demolition costs are added to the basis of the land rather than the new building. Now, why do we care if it is added to the basis of the land rather than the building? Well, if this is a business asset, an asset we're going to use in a trade or business, or an investment type of asset, then the building, we will get to take depreciation expense. We will get to deduct the cost of that building over that building's useful life. The land, as we mentioned, you do not get to depreciate. So if this was an asset we're using in business, we would rather that those demolition costs get added to the building, because we'll get to depreciate it that way over time. We'll get to take a tax deduction for those costs over the useful life of that building. Whereas, since we have to add the demolition cost to the land, we don't get to deduct those costs. They just become part of the basis of the land. Now, if this is a personal building, like if you're building your home, you don't get to depreciate your home because it's a personal asset, so we probably don't really care that it's added to the land instead of the building. But in any case, it is what it is, and for purposes of the exam, you need to remember that any demolition costs are added to the basis of the land rather than the basis of the building. Basis increase after purchase. So when you have an asset, and particularly real property, although the same concepts do apply to personal property as well, but particularly with real property, you can frequently have increases and potentially decreases in basis after you buy it. So what we're primarily concerned about here is increases in basis. So if you make major improvements or additions to the property, your basis increases by the cost of those improvements or additions. So we're talking about big, what we call capital items here. They are capital improvements. That includes adding rooms, driveways, fences, landscaping, flooring, major systems such as a new air conditioner or a new plumbing system, but not repairs of those items. So you do not increase basis for maintenance items such as painting, fixing leaks, filling holes or cracks, or replacing broken hardware. If this is a business piece of property, you could actually deduct as a business expense those maintenance items, the painting and the fixing the leaks and the maintenance on your air conditioning system, the maintenance on your plumbing system. For business purposes, those would be a deduction. If it's a personal asset, then those are just expenses that you have, and that's just the way it is. But if you have these larger items, you don't expense those items, you add them to the basis of the property. So that's increasing your basis after the purchase. For stock, like you buy stock on the stock exchange, there are dividends and splits that we talked about in a previous video. And as you will recall, we said that stock dividends and splits are usually not taxable. So we need to determine our basis in our stock after this stock dividend or split. So what you do is you take your basis in the original shares and you divide by the new number of shares. So let's do a couple of examples. Terrence bought 100 shares of BCD Corp for $1,000, making his basis $10 per share. BCD Corp issued a stock dividend of 0.2 of a share per share. Terrence now owns 120 shares. His basis is $1,000, the amount he originally paid, divided by 120, the number of shares that he now owns, which equals $8.33 per share. So in this case, BCD Corp, instead of issuing a cash dividend, they said for every 10 shares of stock that you own, we're going to give you 2 new shares. It's a stock dividend. So all you do is you take the $1,000 that Terrence originally paid for his stock, you divide it by the number of shares that he now owns, and that's where you get your $8.33 per share. Example 2. Sandra bought 100 shares of XYZ Corp for $1,000, making her basis $10 per share. Later, XYZ Corp announced a split, a stock split of 3-to-1. So Sandra now owns 300 shares. Her basis is her original $1,000 that she invested divided by 300, which is the number of shares she now owns. It's $3.33 per share. So that's how you handle the basis for stock dividends and splits. Sometimes corporations will make non-dividend distributions. You'll often see this on a 1099 dividend. These non-dividend distributions are not currently taxed. Instead, they reduce the basis of your stock. Then when you sell your stock, your taxable gain is going to be greater than it otherwise would have been. So let's do an example. Terrence bought 100 shares of BCD Corp for $1,000. BCD Corp made a non-dividend distribution to Terrence of $100. So now Terrence invested $1,000, but he's gotten $100 of that back. So now his net investment is actually only $900. So his basis in the stock is now $900 divided by 100 shares, because he still owns 100 shares. His basis is now $9 per share. Inherited or gifted property. So the basis of inherited property. So someone dies and leaves you or leaves the taxpayer property. The basis for that person who received the property is the fair market value of that property at death, or if elected by the estate, 6 months after the date of death. So normally it's just the fair market value at the date of death, but the estate, so who's ever administering the estate for the deceased person can choose. They can say, no, we're going to use 6 months after the date of death instead of the date of death for the basis. But for most purposes, you think about it as the fair market value at the date of death. So this is called a step up in basis. So you may hear that term from a tax person. They'll say you get a step up in basis. So what that means is, let's say that, let's talk about you. Let's say your parents bought stock in Walmart back in 1985, and they still own that stock on the day they die. And let's say it's your mother. She owns the stock and she dies. Your father's already dead. And so now you have that Walmart stock. Well, that Walmart stock from 1985 is going, I don't know how much it's going to be worth, but it's going to be a lot. It's going to be worth a lot more than your parents paid for it back then. But for your basis, so if you turn around and sell that stock, we need to compute the gain on the sale of that stock. Your basis is the fair market value at the date your mother died. This is a great result from a tax standpoint. It's obviously very sad that your mother died, but just from a tax standpoint, you're getting a great result here. Because if your mother had sold that stock before she died, she would have paid a lot in capital gains. But because she held it until she died and now you have that property, if you turn around and sell it right away, you're going to pay little or nothing in capital gains, because your basis in that property is going to be considered to be the fair market value the day your mother died. Contrast that with gifted property. If instead of leaving that Walmart stock to you when she died, if she had given it to you while she was still alive, let's say she gifted it to you the day before she died. She said, here it is. I'm going to give you this Walmart stock. And she gives it to you the day before she dies. Now your basis is the same as her basis was. And so now when you turn around and sell that stock, you're going to have a huge capital gain, and you're going to pay a lot of money in capital gains taxes on that property. So the basis of gifted property is the same for the donee as for the donor. So this we call carryover basis. So on death, it's called a step up in basis, because your basis gets increased to the fair market value. For a gift, it is a carryover basis. So your basis does not change. Your basis is the same as the basis of the person who gave that property to you. Now you can see there is an exception here. If you end up selling the property at a loss, then you don't get to use the donor's basis. You have to use the fair market value at the date of the gift. That is your basis in that property. But for most of the time, we're talking about a carryover basis from the donor to the donee. Fair market value. We've used this term already. We're going to keep using it. So we want to understand what the IRS means when they say fair market value, or FMV. FMV is the price at which property would change hands between a willing buyer and a willing seller, neither having to buy or sell, and both having reasonable knowledge of all the relevant facts. So think about two unrelated individuals. One of them wants to buy something, but they don't have to. They're not under any great pressure to buy this asset. It's just something they're interested in buying. And then you have a seller who they'd maybe like to sell the asset, but they're not under any great pressure or strain to sell it. If they sell it, that's great. If they don't sell it, no big deal. So it's a willing buyer and a willing seller. Neither of them has to buy or sell. And they both have got reasonable knowledge of all the relevant facts. So they know about this asset. They know the good things about the asset. They know the bad things about the asset. It's not like the seller knows that it's a car and they know that there's some huge mechanical problem with the car, but the buyer doesn't know that. And so the seller is going to pull a fast one and sell the car for more than it's actually worth. No, the buyer knows everything about the car, the good things, the bad things. They know the same things that the seller knows about the car. So a sale between those two people, whatever the buyer is willing to pay and the seller is willing to accept, that is the fair market value of that asset. So that's the concept of fair market value. Moving on now to the main topic of this video, capital gains and losses. So we already talked about what a capital asset is. There are two categories of capital assets: capital assets held for investment and capital assets held for personal use. So capital assets held for investment, we normally would think about things like stocks, stock rights, bonds, unless those things are held by a securities dealer, because again, at that point, it's a business asset. If they're a dealer in assets, that means they're buying these investments in order to resell them. So it's like inventory to them. Similarly, gold, silver, stamps, coins, gems, assets like that, unless those are held by a dealer. Gains on the sale of investment property are taxed as capital gains. Gains on sale, capital gains. Losses on the sale of these items are deducted as capital losses. So they're capital assets, so gains are capital gains, losses are capital losses. Capital assets that are held for personal use. So these are property that's held for personal use only rather than as an investment. So think about your home, your car, your furniture, your clothing, etc. All of those, they're capital assets, but they are personal use capital assets. The gain on the sale of personal use property are taxed as capital gains, but the losses are not deductible. So this is why when you sell your old car at a loss, which usually you will, that loss is not deductible for tax purposes. But if you were to sell that old car for some reason at a gain, so during the COVID era, the value of used cars went up. And so there were people who actually were able to sell their car for more than they bought it for. And if that happens, then that is a capital gain. And they need to pay tax on the gain of the sale of that vehicle or whatever asset that we are talking about. There is a holding period for capital assets. Earlier, I referred to something as being a long-term capital gain, and that is an important distinction. So long-term means an asset held for more than 1 year. So you acquired it more than a year ago, and now you sell it. That is a long-term capital gain. and any inherited property is automatically considered long-term. So yes, maybe your mom died, you got that Walmart stock, and that just happened a few months ago, and now you turn around and sell that Walmart stock. That is still considered a long-term capital gain, even though you've only had it for a few months. The gain or sale of a long-term asset counts as a long-term capital gain. And those are the gains that are taxed at favorable capital gains tax rates. Short-term capital gains, so this is assets that are held for 1 year or less. Those are still considered quote unquote capital gains, but they are taxed at ordinary tax rates. So if it's a short-term capital gain, you do not get the benefit of the lower capital gains tax rate. You only get that for long-term capital gains. What about capital losses? You can deduct capital losses up to the amount of your capital gains plus an additional $3,000 per year and $1,500 if you are married filing separately. Note, the amount of the loss is the same, $3,000, regardless of your tax filing status, as long as you're not married filing separately. So whether you're single, head of household, qualifying surviving spouse, or married filing jointly, it is $3,000 that you get. And then married filing separately, you only get $1,500. So let's go back up to that first point there. You can deduct the capital losses up to the amount of your capital gains. So maybe throughout the year, let's think about stocks and other investments, because that's usually where this comes into play. So you're buying some throughout the year, you're selling some throughout the year, and you're making multiple transactions, perhaps. Some of those you sell at a gain, some of those you sell at a loss. Well, you can deduct any capital losses you have as long as you've got enough capital gains to cover them. So if you had $10,000 of capital gains during the year and you had $7,000 of capital losses during the year, you can deduct all of those capital losses to offset the capital gains. And so you'd have $3,000 in that case of capital gain, of net capital gain. But if you have $10,000 of capital gains during the year and you have $15,000 of capital losses during the year, your net capital loss then is $5,000, but you can't deduct that whole $5,000. You can only deduct $3,000. That's what this is saying. That's the maximum net capital loss that you can deduct for the year. And if you're married filing separately, it would only be $1,500. And as we'll talk about later, any excess losses, so in our example, you had $5,000 net capital loss, you could deduct $3,000 of that. Any excess, so that extra $2,000 can be carried forward to future years. So how do you calculate your net capital gain or loss? And so there's a few steps here, and steps 1 and 2 you can actually do in either order. You don't have to do step 1 before step 2. You could do step 2 before you do step 1, but we'll look at them in this way. Step 1, you total all of your short-term gains and subtract all of your short-term losses. So these are the assets that you held for less than 1 year. So you take all the ones that you sold at a gain, you subtract all the ones that you had for loss, that you sold for losses. This leaves you with a net short-term capital gain or loss. Second step is you take all your long-term gains and subtract all your long-term losses. This leaves you with a net long-term capital gain or loss. If those positions are opposite, in other words, one of them is a gain and the other one is a loss, then you net the two together to get a net gain or a net loss. If the positions are the same, they're both gains or they're both losses, then you don't need to do any further netting. Then you've got two different kinds of income or loss. When there's a chart you're going to see on the next slide that'll lay this out. So this leaves you with these 4 possible outcomes. You could have a net short-term gain, in which case that is going to be taxed at ordinary tax rates. You could have a net short-term loss, which means those are deductible up to that $3,000 that we talked about, or $1,500 for married filing separately, and the remainder can be carried forward. You could have a net long-term gain, in which case those are taxed at those more favorable capital gains tax rates. Or you could have a net long-term loss, in which case that loss is deductible up to the same $3,000 or $1,500 for married filing separately, and the remainder can be carried forward. And let's talk about those carry forwards. The excess above the $3,000 limit can be carried forward indefinitely. So if you have $40,000 of net capital losses, you only can take $3,000. But then next year you can take another $3,000. The year after that you can take another $3,000, etc., until that $40,000 is used up. Unless you die before you use it all up, in which case any unused losses are lost and they cannot be deducted by anyone. They just are lost. If losses are carried forward from a previous year, then as part of the netting process that we talked about before, so you might keep buying and selling. So again, let's talk about stocks. You're buying and selling stocks, and you do that every year. So if you have carryover losses from last year, and now you're going through your netting process this year, any short-term carryover losses are netted against current short-term gains, and any long-term carryover losses are netted against current long-term gains. I think that makes sense that that is the way that you would do it. So let's do a couple of examples to make this more concrete. Jerry had the following capital gains and losses in 2023. Long term, he sold XYZ stock for a $2,000 gain. He sold ABC Mutual Fund for a $3,000 loss, and he sold FGH stock for a $5,000 loss. Then he had short term, he sold JKL stock for $2,000 gain and MNO stock for a $1,000 loss. So his net long-term loss, he had a $2,000 gain, a $3,000 loss, and a $5,000 loss. So that's $8,000 in losses, $2,000 gain. So that is a $6,000 net long-term capital loss. His short-term gain, he had a $2,000 gain and a $1,000 loss. Subtract the $1,000 from the $2,000, he had a net short-term gain of $1,000. So now we net those two together. His net long-term loss is $5,000. He had a $5,000 net long-term capital loss. He's single. He can use $3,000 of that loss in 2023. The remaining $2,000 of that $5,000 is a carry forward to next year. It can be used next year, or if he can't use it next year, the year after. So it is a carry forward indefinitely until he dies. Example 2. Julie had the following capital gains and losses in 2023. Long term, she sold some stock for a $3,000 gain. She sold a different stock for a $2,000 gain, and she sold another stock for a $1,000 loss. Short term, she sold a stock for a $3,000 gain and a different stock for a $2,000 loss. Now, the difference here is that Julie has a $2,000 long-term capital loss carry forward from 2022. So her net long-term gain, she had a $3,000 gain this year, another $2,000 gain this year, that's $5,000, and then she had a $1,000 loss. So her net gain this year was $4,000, but she's got the $2,000 long-term carryover from last year, so we subtract that. So her net long-term gain is $2,000. Her net short-term gain is the $3,000 gain minus the $2,000 loss for a $1,000 net short-term gain. So now we don't need to net these two together. She's simply got two different kinds of gain. She's single. She's going to pay capital gains tax on the $2,000 long-term gain, and she's going to pay ordinary tax on the $1,000 short-term gain, and she's got no loss carry forward remaining. She used it all up. So how do these get reported? Where do we report them? Well, this is Form 8949. This is where we're going to put the details of the sales and other dispositions of capital assets. So you've got description of property, the date that it was acquired, the date that it was sold, the amount of the sales price, the amount of the basis. This is going to give you, there's various codes that you need to use that you will get primarily from a 1099-B. If you get a 1099-B, and this results in a gain or loss. And that's what these boxes up here are talking about. This is box A, B, and C. And this, by the way, this is part one. It is short term. These are the short term gains and losses are reported in part one. And then you're going to check one of these boxes. It's A, B, or C, and you can read them. This is short-term transactions that you got a 1099-B. So if you are dealing with a brokerage house, for instance, you're going to get a 1099-B showing all of your sales of stocks, bonds, mutual funds, etc. And the brokerage house is going to report those sales to the Internal Revenue Service. So if you get a 1099-B from a brokerage house, you're just going to put on here reported to the IRS, and they'll let you know. The 1099-B will actually say that these were reported to the IRS, so you'll know. The next box B would be for short-term transactions that are reported on a 1099-B, but they were not reported to the IRS. That doesn't happen that often, but it does happen sometimes. And again, you'll know that it'll say on the 1099-B that it was not reported. And then box C is going to be short-term transactions that were not reported to you on Form 1099-B, because not everything that you might sell is something that's going to be sold through, for instance, a brokerage house. It could be some other type of asset. So you would check box C for that, and then you would report all of these items. Then you would move on to page 2, which, not surprisingly, is long-term transactions. And it's the same thing. So it's box D, E, and F, but these correspond to box A, B, and C on the previous page. And then all of these boxes are also the same. You're going to report what the asset is, when you got it, when you sold it, how much you sold it for, how much your basis was, and then what your gain or loss is. And then once you have all of those long-term and short-term gains, then those are going to flow up to Schedule D. And so this is Schedule D. It's got part 1, short-term gains and losses. Part 2 is long-term gains and losses. And so you're going to report those here, and the things that flow up from the 8949 go on here, and then it is going to give you a net long-term capital gain or loss that is going to go up to your Form 1040. This is page 2 of the Schedule D, which is just a summary of everything that then is going to flow up to the 1040. Capital gains. I've been saying that capital gains get favorable tax rates. And so this chart is the answer to your question, which is you keep talking about these favorable tax rates. What do you mean? What are they? These are those favorable tax rates. So over here on the left, we're going to separate taxpayers into their filing status and the amount of taxable income that they have. Then you can see their capital gains rate. And then for comparison purposes, you can see what their ordinary tax rates would be for the same amount of income. So if you have a taxpayer that has a capital gain and their taxable income, let's say they're single, if their taxable income is $44,625 or less, they're going to pay 0% capital gains tax rate. So if they sell an item, a capital asset, a long-term capital asset, they have a long-term capital gain, and their total taxable income is $44,625 or less, they will pay 0 tax on that capital gain. Now, of course, they're going to pay taxes on the rest of their income, and the rest of their income, the taxes they're going to pay is 10 to 12%, depending on exactly where they fall within these ranges. So 0% capital gains tax rate, 10 to 12% ordinary tax rate. And you can just move up the chart. So the next, you look at these brackets of income. So here, let's look at married filing joint. If they make $89,251 to $553,850. Their capital gains tax rate is 15%, whereas their ordinary income tax rate is 22 all the way up to 37%, again, depending on where they fall within these brackets of taxable income. So you can see that's big savings. And then you get to this third bracket, which is the high earners. Their capital gains tax rate is 20%, but that compares to 35 to 37% for their ordinary tax rate. So you can see you're saving anywhere from 10% up to 17% in taxes on your long-term capital gains. This is why investors want capital gains taxes rather than ordinary tax rates. You can see here at the bottom, there's some exceptions to this chart. We will talk about each of these in this video, so you can read what they are here, and we'll get into the details of those later. But the main thing is to know, you want to know there's three different capital gains tax rates. They are 0%, 15%, and 20%. You don't need to memorize these numbers as far as what the brackets are. Just be familiar with them so you understand where those brackets fall, and just know that these are the capital gains tax rates. You are going to want to know those rates. Securities sales. As we've already discussed, many capital gains transactions involve securities, stocks, bonds, mutual funds, things like that. These are usually reported, as we said, on a 1099-B from a brokerage house, and they will often give you all the information you need. They'll give you the sales price, the basis, the dates, all of it. They'll even give you little codes that have to go on that form where we saw before. They'll give you everything you need right on the 1099-B. And then keep in mind that mutual funds can generate capital gains in two different ways. First of all, the gains that the fund has from buying and selling securities. So a mutual fund is just a lot of individual people put their money together. Then the mutual fund, there's a manager of the mutual fund. They take all the money from all those individual people, and then they go out and buy securities. They can buy stocks, bonds, other types of securities, but let's just say stocks for now. They can go out, they buy stocks in all different kinds of companies. And then they're going to sell during the year. They're probably selling some stocks. So they're buying and selling throughout the year. So the mutual fund is buying and selling stocks. So they're going to have gains and losses from buying and selling stocks. And so then at the end of the year, since you're one of the owners of that mutual fund, they're going to report that your share of the gains and losses from selling those stocks is X amount. And they'll put that on a 1099-B. So that's one way that you can have capital gains from a mutual fund. The other way is from buying or selling the mutual fund itself. So you've got a share of that mutual fund and you can sell that share to somebody else. So you bought the mutual fund for a certain price and now you're selling it for a certain amount. So you can have a gain or loss on the sale of that mutual fund share. So that's two different ways to have capital gains from a mutual fund. Capital gain distributions are sometimes made. So you might get a distribution that says, okay, we're giving you this money and it is a distribution of all the capital gains that we've earned in this mutual fund during the year. So if they do that, you will get that reported to you on a 1099 div form. You always report that as a long-term capital gain. So it doesn't matter how long you've held that stock or mutual fund. You don't have to figure out, well, where the mutual fund itself, they were buying and selling. Maybe some of those were short-term, some were long-term. You don't have to worry about it. If you get a 1099 dividend, about a capital gain distribution, you get to treat that as long-term, which means you get the favorable capital gains rates regardless. Liquidating distributions. When a corporation is partially or completely liquidating, they might make distributions to the shareholders. So let's say there's a business, they're going out of business. So they're going to sell all their assets and pay off all their debts, and whatever is left, they're going to return to their stockholders. So first, amount that you get back is a return of capital or basis. So if you paid $1,000 for some stock in a company, and now that company goes out of business and they liquidate, maybe they do a liquidating distribution to you of $1,500. Well, the first $1,000 of that, you're just getting your money back. So there's no gain on that. You don't have to pay tax on that first $1,000. But any excess, so in our example, the excess $500, that is a capital gain. And if it is a total liquidation, you might actually have a loss. Maybe you invested $1,000 and you're getting $700 back. In that case, it's a total liquidation. You received less than you paid for it, so that at that point is a capital loss. In our example, you'd take a $300 capital loss. Worthless securities. So if you buy a stock or similar instrument, security, some point, that has become completely worthless, then that is a loss. You treat it as if you sold it on the last day of the tax year. You report it on the Form 8949, but you must be able to support that it is worthless, such as there was a complete liquidation, or it was a bond that you owned and now that company's out of business, or they declared bankruptcy and they've determined there's not enough money left to pay the bondholders, anything. And so that would be a complete liquidation, completely worthless, and you could take that as a capital loss. Wash sales. A wash sale occurs when you sell stocks or securities at a loss, and within 30 days before or after that sale, you buy substantially identical stock or securities, or you meet any of these other criteria. Substantially identical stock or securities, or a contract or option to acquire substantially identical stock or securities, or you acquire substantially identical stock or securities within your IRA or Roth IRA. So what are we talking about here? So some investors sometime in the past have got a idea in their head, a way to save money on taxes. So let me give you a simple example. Let's say it's December of 2023, and you've got a stock that you bought, and you bought it for $10,000. And if you look at the market price today, that stock is only worth $6,000. But you still like the stock, you still believe in the company, and you think that eventually that stock price is going to come back and you're going to make money on that stock. So you don't really want to sell it because you think it's a good company. You think it's a good stock. But an idea occurs to you. You say, well, I've got a loss, a $4,000 loss in this stock. So here's what I'm going to do. It's December. I'm going to sell that stock today for a $4,000 loss, and then I'm going to turn around tomorrow and I'm going to buy some back. So I'll buy it back. I'll sell it today for $6,000. I'll buy it back tomorrow. The price tomorrow will probably be about the same as it is today. So I'll buy it back tomorrow for $6,000. So I'll still own the same stock that I owned yesterday, but now I've got a $4,000 capital loss that I can take on my taxes. And the IRS is saying, no, you can't do that. That is a wash sale. So if you buy and sell the same security or substantially the same security within 30 days of each other, before or after, then that is a wash sale. So in other words, you can't say, I'll buy $6,000 worth today, and then tomorrow I'll sell my stock that I bought for $10,000 that's worth $6,000. I'll sell that for $6,000. And I'll take the loss tomorrow. That doesn't work either. The sale can be before or after. Also, you can't say, well, okay, this stock is in my regular brokerage account. So what I'll do is I'll sell it in my regular brokerage account and I'll buy it in my IRA account. That doesn't work either. That is still considered a wash sale. Wash sale losses are not deductible. You still do report them on your 8949. They will usually be listed on the 1099-B, and there'll be a little code on there that says that this was a wash sales. So you will report it. You'll put that code on the tax return on the 8949, and then there will be no loss allowed on that sale. Options. Gain or loss from the sale or trade of an option to buy or sell property that is or would be a capital asset in your hands is a capital gain or loss. And again, usually we're talking about stock options here. So you get an option to buy a stock at a future date. That is a stock option. Or you could have an option to sell a stock at a future date. That is also a stock option. If you have a loss from an option because you did not exercise it, it is considered a sale and a capital loss. So, for instance, if you're buying a stock option, so sometimes maybe there's a stock that today the market price of that stock is $20, and you think that the price of that stock is going to go up. So you might buy an option to buy that same stock 3 months from now at $21 per share, because you're thinking that 3 months from now that stock is going to be worth more than $21. So if you have an option to buy it for $21, that's a great deal. So let's say now it's 3 months from now and that stock is worth $25 a share. Well, you get to buy it at $21 a share. So you're going to make automatically a profit of $4 a share on that option. But what happens if it goes the other way? So you thought the stock was going to be worth more 3 months from now, but it turns out that stock 3 months later is only worth $19 per share. Well, obviously, you're not going to go out and exercise that option to buy it at $21 because you can just go on the open market and buy it for $19. That wouldn't make any sense. So that, and nobody else is going to pay you anything for that option. It's worthless. So that option, you're not going to exercise it. But now you can actually take a loss for how much ever you paid for that option. That is now a capital loss. If that option is part of a straddle, so a straddle is an investing strategy where you buy one option to buy the stock and you buy a different option to sell the stock. You buy both options at the same time. You don't report the gain or loss on that until both of those options have settled, till they've either both expired or until you've exercised one and let the other one expire, or whatever the case may be. So both have to happen before you get to recognize the gain or loss on those options, on that straddle. Incentive stock options. We talked about these in the previous videos. You saw this slide just as a reminder. Statutory stock options, no income until you sell or exchange the stock, and it's taxed at capital gains rates as long as you meet all of the requirements. Non-statutory stock options, those are generally income when it is received. So when the option itself is received, as long as the fair market value can be determined. If the fair market value cannot be determined, then it's taxable when it's exercised or sold, and these are also taxed at capital gains tax rates. Employee stock purchase plans, or ESPP. This is a corporate benefit that allows employees to purchase the company's stock at a discount. As long as it's a qualified plan, no income is recognized until that stock is sold. And if it is sold more than 24 months after the offering date and more than 12 months after you purchased it as the employee, then you get favorable tax treatment. And that favorable treatment is that the gain is considered a mix of ordinary gain and capital gain. And you will get a form from your employer, a Form 3922, that shows the amount that is ordinary and the amount that is capital. So just remember for the exam, employee stock purchase plan, as long as you meet these requirements, the 24-month, 12-month requirement, then you will get a favorable rate, which is a mix of ordinary and capital. Publicly traded partnerships, or PTPs. This is a partnership with ownership units that are traded on an established securities market. So it's a partnership unit that's traded like a stock. That's what a publicly traded partnership is. Because it's traded like a stock, publicly traded partnerships are treated as if they were corporations. So it's treated as if you were buying or selling stock, which means the gain or the loss is very straightforward. So if you have a PTP, you buy it on an exchange, a stock exchange, and then you sell it on the stock exchange, you treat it just like you would a stock. You sold it for an amount, you bought it for an amount, the difference is your gain or loss. However, there's an exception. If 90% or more of that PTP's income comes from passive income, then it's not treated like a stock, it's treated like a partnership, which means the owners will get a Form K-1. Any losses that flow through from that PTP are passive losses. Remember, passive losses can only be used to offset passive gains. You can't take a net passive loss. They're subject to those passive activity loss rules. So PTPs usually treated like a stock unless 90% or more of their income is passive income, and then it's going to be treated as a partnership. Cash distributions from a PTP that are treated as a partnership. So if you have one of these that's got 90% of their income is from passive income, cash distributions from that partnership can lower your basis, resulting in a higher than expected gain once you sell that PTP. Remember, we talked before, if you get a non-dividend distribution for a stock, that distribution lowers your basis. Well, it's the same thing here with the PTP. If you're getting a cash distribution from one of these PTPs that's treated as a partnership, that is going to lower your basis in that PTP. So when you sell it, your gain is going to be larger than it otherwise would have been. And these rules can get very complex. So some of that gain might be ordinary rather than capital. You don't need to know the details of that for the exam. Just know that that situation exists. Small business stock. So this is called Section 1244 stock. And you're going to want to remember that because we're also going to be talking about other types of small business stock. So we've got different types. So this is 1244 stock. This is stock in a domestic small business that is primarily operating a business rather than investing, and you are the original owner of the stock. So this is not a corporation you put together in order to hold investments. This is a corporation that you put together in order to run an actual business. That is a small business Section 1244 stock. The loss on the sale or worthlessness of small business stock can be treated as an ordinary loss. So remember, usually you own stock in a corporation, that is a capital asset, and any loss would be a capital loss, and capital losses are limited. But what we're saying here is for this specific type of Section 1244 stock, you can treat much of that loss as an ordinary loss. You can treat up to $50,000 of your loss on that stock as ordinary, or $100,000 if you are married filing jointly. Any remainder, so if you've got more than that, if your loss is greater than that, then the remainder would be treated as a capital loss. On the other hand, any gain on the sale of Section 1244 stock is a capital gain. So this is the best of both worlds. You get a capital gain if you sell it at a gain, and you get an ordinary loss if you sell it at a loss, at least up to that $50,000 or $100,000 limit. Another type of small business is a small business investment company, or SBIC. This is one that is licensed and operated under the Small Business Investment Act of 1958. A loss on the sale or worthlessness is an ordinary loss without limitation. A gain is a capital gain. So again, this is the best of both worlds. Capital gain, ordinary loss on an SBIC. Section 1202 stock. This is qualified small business, or QSB stock, also called Section 1202 stock. This is what you'll usually hear it referred to as is Section 1202 stock. This is for a C corporation operating a qualifying business, and the stock has been held for at least 5 years. You can exclude all or a portion of the gain on sale of Section 1202 stock up to $10 million. That is not a typo. Up to $10 million, or 10 times your initial basis, whichever is greater. $10 million or 10 times your initial basis, whichever is greater. This means the gain is tax-free. It's not even taxed at capital gains rates. it is tax-free. So if you qualify, it's not easy to qualify for this, but it has to be a C corporation. It's got to be a qualifying business. You have to have held it for at least 5 years. But if you meet all of the criteria, you can exclude up to $10 million of the gain on the sale of that stock. If it was acquired before February 17th of 2009, you can only exclude 50% of the gain. And then you can see there was a short period of time in there where you could exclude 75% of the gain. And if it was acquired after September 7th of 2010, you can exclude 100% of the gain up to $10 million. So you're going to want to know, first of all, you're going to want to remember that for the exam. And secondly, you're going to want to look out for this. If you have clients that they've got, this is going to be their own business. They started the business. They've got a C Corp. They've owned it for at least 5 years. Again, there's other criteria that have to be met. But if they meet this criteria and they're wanting to sell their business, this is a great deal. All right, investors, dealers, and traders. We've talked earlier about investors and dealers, and we're going to talk in more detail about them. We're also going to talk about traders. Investors. This is someone who buys and sells securities and expects income from dividends, interest, and capital appreciation. They typically hold the securities for a substantial period of time. They're not in the business of investing. So this is most of us. If you own any mutual funds or stocks, even savings accounts that pay interest, and you're not in the business of doing that, it's just that you've got your regular job, you're a tax preparer, and you've also got some investments, then you are an investor. So this is most people who own securities. We are investors. The sales of those securities result in capital gains and losses, as we've been talking about through this video, and those are subject to the normal capital loss limitations that we've been talking about in this video. Dealers. Dealers are people or entities that purchase securities and resell them to their customers, and they may keep an inventory of these securities. They derive their income from marketing the securities to customers or by being compensated for services provided as an intermediary or market maker. They must use what are called the mark-to-market rules, which we will talk about here shortly. So these are people, think of them as merchants for securities. They buy them, keep an inventory, and then they sell them to investors. They're like a middleman for securities. They are dealers, and they must use the mark-to-market rules. Traders. Traders are in the business of buying and selling securities for their own account. So it's considered a business even though there's no inventory, there's no customers, but they must meet some conditions. They have to be seeking to profit from daily market movements. Their activity must be substantial, and they must carry on the activity with continuity and regularity. So if you think of day traders, these are people, this is their job. They're sitting there all day, every day, looking for opportunities and buying and selling different securities to try to make a profit. That is what a trader is. They report their expenses on Schedule C because they are a business, but they don't have to pay any self-employment tax. So that's a little bit different. Most of the time you have a business on Schedule C, then any profit, you're going to pay a self-employment tax. But traders do not have to pay a self-employment tax, and they can elect to use the mark-to-market rules if they want to, and we will talk about that next. What does mark-to-market mean? Mark-to-market means that at the end of the year, so it's any securities that you hold at the end of the year must be treated as if they were sold at their fair market value on the last business day of the year, and then you must recognize any gain or loss that results. So you look at your portfolio of securities that you have. You look online and see, okay, what are these securities? How much are they? What's their value today? If I sold it today, what would be my gain or loss? And you have to compute that for every security that you have. And then you recognize any gain or loss if you use this mark-to-market system. So let's talk about the mark-to-market election. Traders get to elect. Dealers don't get to make this election. They must use mark to market. So remember, these are the ones that are buying securities, holding them as inventory, and then selling them to investors. They must do mark to market each year. They have to look, what's the value of these securities that I hold? How much did I pay for them? What's the difference? They have a gain or loss depending on that. Traders, so someone who's like a day trader, they can make an election to do mark to market if they want to. If they make a valid mark to market election, then all their gains and losses are treated as ordinary. So they don't get the benefit of capital gains treatment. But they don't get the limitation of capital loss limitations. So they're not subject to capital loss limitations, and they don't have to worry about the wash sale rules. Those do not apply. So remember, you can't recognize a loss on a wash sale. Well, if you make a mark-to-market election, you can recognize the loss from wash sales. So if they want to, if a trader wants to, they can do this and say, okay, my gains and losses will be ordinary. And so I don't get the favorable capital gains rates, but I don't have to worry about the $3,000 a year loss limitation. And I don't have to worry about the wash sale rules. And so they can make that election. If they don't make that election, then their gains and losses are treated just like anybody else's. So they have to actually make the election. They have to tell the IRS, hey, IRS, I want to do this. If they don't do that, then they haven't made a valid election, so their gains and losses are going to be treated just like yours and mine. Any gains are capital gains, any losses are capital losses, and they're limited to $3,000 per year. They have to make this election by the due date of the prior year's tax return, so basically by April 15th. So for 2023, if they want to make this mark-to-market election, they have to make that election by April 15th of 2023, because that's when their 2022 tax return was due. So they can't wait to the end of the year. That would be great. If you were a trader, you could just wait until December, figure out, did I have more gains or losses this year? Oh, I had gains. Well, I'm going to not make the mark-to-market election so that my gains can be taxed as capital gains. Or they could say in December, oh, I've had losses this year. I've had $40,000 losses. I'm going to make the mark-to-market election because I don't have that $3,000 limitation. That way I can deduct my whole $40,000. So you can't do that. You have to make this decision early in the year. So you need to make it by the due date of the prior year's tax return, which is usually April 15th. If you want to revoke an election, so once you make the election, so if you make the election 1 year, that election is going to remain in effect until you revoke it. So if you're going to revoke it, you also have to revoke it by the due date of the prior year's tax return. So if you want to revoke that, again, you have to decide by April 15th to revoke that election. There's another part of mark-to-market. This is for Section 1256 contracts. And this says if you've got one of these types of contracts, so you use mark to market and you have one of these kinds of contracts, it's going to be treated in a special way. These are regulated futures contracts, foreign currency contracts, non-equity options, dealer equity options, and dealer securities futures contracts. If you're using mark to market and you have any of these types of contracts, then they are treated a little bit differently. You must treat it as if it's sold at its fair market value on the last business day of the year, just like you would with any other securities, and you must recognize any gain or loss that results. However, it's treated a little bit differently. 60% of your gain or loss is going to be considered long-term, 40% is going to be considered short-term. So you don't look at your holding period for those assets. Instead, you just say 60% is long-term capital, 40% is short-term capital, and that's the way you report your gain or loss for these Section 1256 contracts. And as you can see there, this does not apply to what are called hedging transactions. Digital assets or cryptocurrency. So for federal tax purposes, digital assets are treated as property, as any other kind of property. So the general tax principles applicable to property transactions apply. So in other words, it's not considered currency, it's just considered property. And remember, on page 1 of the 1040, you must check that box about whether or not you received or traded in any digital assets. You can have a taxable gain or loss from many different transactions in cryptocurrency, including but not limited to all those that are on the screen. So you can sell them. Obviously, you could have a gain or loss, just like you have a gain or loss on the sale of any other property. You could exchange it for something else. That could result in a gain or loss. You could exchange one digital asset for another, could have a gain or loss. You could receive a digital asset as payment for goods and services. So some people are doing this. They're offering a service. They are accepting crypto for that. They could have income from that. They could receive a new digital asset from a result of a hard fork or from mining or staking. I'm not an expert in this. I barely understand what those terms mean. If you're into cryptocurrency, you understand what those current terms mean. But the point is, you could, if you receive an asset as a result of those, then you've got tax consequences from that. You could also receive it from an airdrop. Any other disposition of a financial interest in a digital asset can result in a gain or loss. And a receipt or transfer of a digital asset for free does not qualify as a gift. So you can't just say, well, I am giving you this. That doesn't work. Not a gift. It's going to result in a gain or loss. Gains and losses are treated the same as others, meaning the same as a gain or loss on any other type of property. If the fair market value of the crypto received exceeds your basis, then you have a gain. If the basis exceeds the fair market value of the crypto received, you have a loss. If it's capital, it's taxed at capital gains rates as long as it's long term. Losses are limited to $3,000, just like any other capital asset. If it is ordinary income, so instead of buying or selling, you are receiving it, such as by a self-employed person who's performing services, then you treat that as gross receipts in your business at the fair market value at the time received. So you don't wait to the end of the year and say, well, the price of this dropped or the price of this went up. Either way, it doesn't matter. It's how much was it worth on the date that you received it for performing those services. That amount of income is going to be business income. Then that is also going to be your basis in that cryptocurrency. So then if the fair market value goes up or down, once you dispose of it, you will have a gain or loss based on your basis, which your basis again is going to be the fair market value on the date you received it. If you use it to pay for business expenses, then it's the same idea. The expense is the fair market value at the time that it was paid. This could also result in a gain if the basis is lower than the fair market value. So if you bought it for one price and now you're using it to pay an expense for a greater value than you bought it for, you could have a gain on the disposal of that cryptocurrency. So let's say you bought it for $100 and now you pay somebody to do work in your business, to do some carpentry work in your business to add on a space. And that carpentry work is worth $500. Well, now you have a gain because the amount, the service that you received in exchange for that cryptocurrency is greater than the amount you paid for that cryptocurrency. So you've got a gain on the disposition of that currency. You use a 1099 miscellaneous. If you are a business and you paid out $600 or more worth of cryptocurrency to an individual or a partnership, then you must issue a 1099 miscellaneous for that amount. And we'll get into more of 1099 rules in part 2 of this course. But just for now, know that there does need to be a 1099 miscellaneous. And you as a taxpayer might receive a 1099 miscellaneous if you were on the receiving end of the cryptocurrency. And for more details about this, there is an IRS notice 2014-21 that will explain the ins and outs of digital assets. This is an area of the tax law that is evolving, and the IRS they're learning and they're trying to figure out more precise rules and different rules and additional rules as the world changes. Collectibles. So collectibles are going to be things like art, rugs, antiques, metals, gems, stamps, coins, alcoholic beverages, musical instruments, historical objects, and similar assets. Those are collectibles. This is another one of those asterisk items that was on the capital gains tax chart that we showed earlier. So these are taxed, the sale of these are taxed at ordinary rates, even though they are capital assets, they are taxed at ordinary rates. However, the maximum ordinary rate they are taxed at is 28%. So if you remember on that capital gains tax chart, we had the capital gains rates, and next to it we had the ordinary income tax rates that went all the way up to 37%. So collectibles are taxed at ordinary rates, but the maximum is 28%. So even if you're in the 37% tax bracket, if you sell a collectible at a gain, you will only pay 28% tax on that gain. Losses on the sales of collectibles are not deductible unless they were specifically held for investment. So this depends on your intent of purchasing that. Did you purchase it just for personal enjoyment or for the expectation of a profit? So if you think about like baseball cards, did you just collect the baseball cards because you like baseball and you like baseball cards? Or were you buying it because you thought this is a good investment and I can buy it now and I can turn around later and sell it? So the IRS is going to look at the facts and circumstances on a case-by-case basis, because if you sell that investment at a loss, then it is only deductible if you held it for investment. It's not deductible if you held it for personal purposes. Bad debts. If you have a business bad debt, then that is going to be deductible by the business. We'll cover that in part 2. But for part 1, we're talking about non-business bad debts. These might be deductible as a short-term capital loss if they meet the following criteria. First of all, it has to be a genuine debt, not intended as a gift, and a loan from a parent to a minor child to pay for their basic needs is not a genuine debt. So obviously at some point somebody had that bright idea. They're just going to consider everything they paid for their children growing up as a loan, and then they're going to write that loan off. No, you can't do that. The second thing is you must have basis in the debt, which means you've actually loaned out cash. You can't get a bad debt because somebody didn't pay you something they were supposed to pay you. So maybe they were supposed to pay you child support and they didn't pay you child support. Well, that is not a bad debt. You don't get to take a deduction for that on your taxes. You can deduct the debt as long as it meets those criteria. It's a genuine debt. You have basis in the debt. You can deduct it in the year that it becomes worthless, which means there's no longer any chance it will be repaid. That's what worthless means. No longer any chance that it will be repaid. Non-capital assets. So we've been talking about selling capital assets. What about sales of non-capital assets? This is usually going to be a business transaction. So it's going to be reported on the appropriate business tax form, which is usually Form 4797, and we will talk about this in part 2. So for now, let's move on to non-taxable and other sales. So we've been talking about taxable sales, but there are some sales that are not taxable. Let's talk about those. First of all, transactions between spouses. So generally, there is no gain or loss recognized on a transfer of property between spouses, or if incident to divorce, former spouses. So any such transfer is treated as a gift. So the receiving spouse's basis is the same as the gifting spouse, just like any other gift. But even if the property is sold for a loss. So you remember when we were talking about basis of gifted property, and we said that usually there is carryover basis between the one giving the gift and the one receiving the gift. But there was an exception to that, and that was that if the property was sold for a loss, then you had to take the fair market, you had to use the fair market value or the basis, whichever was lower, as basis. Well, that doesn't apply if the people giving and the receiving gifts are spouses or former spouses incident to divorce. So just remember here, first of all, two people are married. They're not getting divorced. They can give each other property back and forth all day long, or sell property to each other all day, back and forth all day long, doesn't matter. There's going to be no tax effect. Basis isn't going to change. The basis is going to be the same. And so that's the way it is for transactions between spouses. But usually this comes up in divorce situations where you are dividing property and giving one thing in exchange for another thing. And they're just saying, we're going to treat that as if you were still married. And so there is no gain or loss. Related parties. Losses on sales between related parties cannot be deducted. So this is going to be family members or a corporation and they're greater than 50% owner, fiduciary and beneficiary of the same trust, etc. So there are lists of these, but just if you're taking the exam, it's going to make sense. You've got a parent and a child. You've got brothers and sisters. If you're closely related parties and you have a loss on a transaction, you do not get to deduct that loss. What the IRS is trying to do here is to stop abuse. They don't want families or closely related people generating tax losses out of thin air by saying, hey, here, I'll sell this to you at a ridiculously low price so that I can get a tax loss. And then you can just let me keep using that asset or whatever it is. So they don't allow tax losses on sales between related parties. Gains, on the other hand, are taxable. So if you sell something to a related party at a gain, then it is taxable. Sale of the primary residence. So if you sell your house, that is a capital asset, as we discussed previously. And the general rule is that the gain on sales of capital assets are taxable income, even if it's a personal asset. Remember, you can't take a loss on the sale of a personal asset, but you do have to pay tax on the gain from the sale of a personal asset. But when it comes to your primary residence, there are special rules that may allow you to exclude all or part of the gain. So the general rule is this: if you qualify, which we'll talk about, you can exclude up to $250,000 of gain if you're single, head of household, or married filing separately, and you and your spouse can exclude up to $500,000 of gain if you are married filing jointly. Now this is gain, not just sales price. So if you bought a house for $300,000 and you sell it for $700,000, your gain is $400,000. So if you are married filing jointly, your gain is $400,000, you can exclude that entire gain. So the fact that it sold for more than $500,000 is not what's important. What's important is how much is the gain. That's what we're talking about here. And then do remember that you cannot deduct a loss on the sale of your primary residence. So if you end up with a loss, sorry, that is not deductible. But we're going to focus mostly on the gain. So to qualify for that exclusion, you have to meet both of the following tests. And there's kind of three tests in here, but they call it two tests. So that's what we'll call it. Test number one: during the 5-year period ending on the date that you sold your home, you owned it for 2 or more years. That's the ownership requirement. And lived in it as your main home for 2 or more years. That is the use requirement. So you owned it for 2 years or more, and you lived in it for 2 years or more. The 2 years of ownership and the 2 years of use do not need to be the same 2 years. So you look back to the last 5 years, at least 2 years during that 5 years you had to own it, at least 2 years during that 5 years you had to live in it, but those periods do not have to overlap, and we will use examples to show you how this might work. If you are married filing jointly, in order to double the exclusion to $500,000, only one spouse has to meet the ownership requirement, but both spouses have to meet the use requirement. So that's test number 1. Test number 2. You haven't excluded the gain on the sale of a primary residence of another main home during the 2-year period ending on the date of the sale of your home. So in other words, you can only do this every 2 years. You can't do it one time, buy a new house, sell it 1 year later, and now exclude that gain as well. It has to be at least 2 years since you last took this exclusion. So examples. John is single and started renting a house as his primary residence on August 1st, 2018. On July 1st, 2020, he bought that house and he continued to live in it until October 1st, 2020, when he got married and moved into a new house with his wife. He allowed his brother to live in his first house until John sold that first house on August 1st, 2023, realizing a $200,000 gain. John can exclude the gain because he owned the house for 3 years and 1 month as of the date of sale. So he owned it from July 1st, 2020 to August 1st, 2023. So he satisfied that ownership test. And he lived in the house as his primary residence for 2 years and 2 months out of the last 5 years. So he lived in it from August 1st, 2018 to September 30th, 2020, satisfying the use test. Now notice, when he first lived in the house, he did not own it. He was renting, but it doesn't matter. All that matters is that he lived in it as his primary residence for at least 2 years out of the last 5 years. So this is why those two tests, the ownership test and the use test, they don't have to be the identical periods of time, because you may have lived in that house before or after you owned the house. It doesn't matter as long as you meet these tests. And note that he can exclude up to $250,000 of that gain, whether he files married filing jointly or married filing separately. So up to $250,000 of the gain. Now, what if he had had a gain of greater than $500,000? He's married filing jointly. Would he be able to exclude $500,000 of gain married filing jointly? Well, remember, his spouse has to meet the use requirement in order to double that exclusion to $500,000. His spouse, if we look at the facts of this, she never lived in that old house. They got married and moved into a new house. He moved in with his wife, and there's nothing to tell us that his wife lived with him prior. So assuming she didn't live with him in the old house prior, then he could only exclude $250,000 of gain. He does not get to double that to $500,000. In our particular example, it doesn't matter because his gain was only $200,000 anyway. But that's the way those rules work. Example 2. Maria is single and bought a house on July 1st, 2019 in New York and lived in it as her primary residence. On January 1st, 2021, she entered into a 2-year master's degree program in California where she rented an apartment. While she was in California, her brother lived in her New York house. On February 1st, 2023, Maria decided to stay in California to pursue a doctorate, and she sold her New York house, realizing a gain of $200,000. Maria must pay capital gains tax on the $200,000 because even though she met the ownership test by owning the house for 3 years and 7 months from July 1st of 2019 to January 31st of 2023, she did not meet the use test since she only lived in the house for 18 months from July 1st of 2019 to December 31st of 2020 instead of the required 24 months. So in that case, she did not meet the tests. She cannot exclude the gain, so she has a $200,000 long-term capital gain. We will revisit Maria shortly, but for now, let's talk about a partial exclusion of gain. If you don't meet the eligibility test, there is a chance that you might still qualify for a partial exclusion. In order to qualify, then the reason you sold your home has to be due to a change in workplace. It has to be health-related or from some other unforeseeable event. So if you sell your home for one of those reasons, then you might be eligible for a partial exclusion of the gain. The exclusion amount is the percentage achieved of the failed test multiplied by 250,000 or 500,000 if you're married filing jointly. So if you failed the test because you only lived in the house for 12 months instead of 24 months, then you can exclude half of the 250,000 or $125,000 of the gain. So let's look at an example. Maria, again, this is the same fact pattern that we read before, but with one big change. Instead of going to pursue a master's degree, she accepted a 2-year out-of-state assignment with her employer. And then instead of pursuing a doctorate, her employer offered her a permanent position out there in California, and she accepted. And then she sold her New York house. So now the reason she sold her house is because of a change in job location. Because of that, she qualifies for a partial exclusion. So she met the ownership test, we know that, but she did not meet the use test because she only lived in the house for 18 months instead of 24 months. So what that means is she can exclude 18 of 24 months times $250,000 or $187,500 of the gain. So she can exclude, she had a $200,000 gain. She can exclude $187,500, but she must pay a long-term capital gains tax on $12,500 of that gain. Depreciation recapture. If you rented your home or rented it out, or you took a home office deduction, then you may have been entitled to a deduction for depreciation. If so, when you sell that home, you have to recapture, meaning pay tax on that depreciation. So even if the gain can otherwise be excluded because you meet all the tests, you will still be taxed on the amount of depreciation that you took or that you could have taken even if you did not take it. And the tax that you will pay on that depreciation is ordinary tax up to a maximum of 25%. So this is the other asterisk item on that capital gains tax chart. It's for depreciation recapture. You're going to pay ordinary tax rates, but the maximum, instead of going all the way up to 37%, is only going to be 25%. And the purpose for this is to prevent a taxpayer from getting a double benefit by deducting part of their house as depreciation and then also excluding the gain on the sale of that house. So this prevents that double benefit. So let's do an example. Lawrence is single and in the 35% tax bracket. He bought a home and rented it out for 2 years, taking $22,000 in depreciation deductions before moving into it as his primary residence. After living in the house for 3 years, he sold it for a gain of $200,000, which is excluded because he meets the tests, right? He lived in it and owned it for more than 2 years out of the last 5 years. So he gets to exclude the gain. However, he rented his house out. So as part of that, he was able to depreciate the house. and he took $22,000 of depreciation deduction. So now when he sells the house, he has to pay tax on that $22,000 up to a maximum of 25%. In his case, that's how much he has to pay is 25% because he's in a 35% tax bracket. So he gets to exclude the $200,000 except for that part that he took depreciation on, the $22,000, in which case he's going to pay 25% tax on that. Reporting the sale of a home. You need to report the sale of your primary residence on Form 8949 if either of these two conditions is met. Either you cannot exclude all or part of the gain, or you received a Form 1099-S. So a 1099-S will come from, usually it's the title company or whatever entity did the closing on the property. We'll just call it the title company. So the title company, if they have reason to believe that this is not your primary residence, then they are going to issue a 1099-S. If they know this is your primary residence, then they're probably not going to issue you a 1099-S. So note here, if you can exclude all of the gain and you did not receive a 1099-S, then you do not have to report the sale of your home on your tax return. I find this to be fascinating. Selling your home is likely to be the largest financial transaction in most people's lives. And everybody, we always think of the IRS as that they're out to get every penny they can get. And here we are, largest transaction of your life. And if you can exclude all the gain and you don't get a 1099-S, the IRS never knows about it. You don't report it. The title company doesn't report it. Nobody reports it. You sell your house. You don't mention it on your tax return. IRS never knows the difference. And it's never reported to them. I just think that's interesting. But remember, if you can't exclude all of the gain for any reason, or if you do receive a 1099-S, then you do have to report it. And if you have depreciation recapture, that is reported on line 19 of Schedule D. And there is this publication that's all about selling your home that has all of these rules in it. So if you want more information, you can check that out. Foreclosure or abandonment on your home. So normally, as we talked about in a previous video, if a debt is forgiven, the amount forgiven is cancellation of indebtedness income. But there are some exceptions, as you'll recall, and one of those exceptions is for qualified principal residence indebtedness. If a home is foreclosed on and the lender accepts the proceeds of a short sale, or the owner hands over the keys to the lender and abandons it, and the lender accepts the property or proceeds as full satisfaction of the debt, then the amount of that debt forgiveness may be eligible for exclusion from income. So certain criteria have to be met. First, the debt was used to buy, build, or improve the home, or it was a debt that was refinanced. It refinanced a debt that was used to buy, build, or improve the home. If it was a cash out refinancing, and that cash was used for something else, such as paying off other debt, then the cashed out amount is not eligible. Then the other criteria is it has to be your main home. So this is not for your vacation home. This is for your main home only. When you do this, the lender will issue a Form 1099-A to the borrower that will be used to report it on your tax return. So let's look at an example. Peter borrowed $200,000 to buy his house. Later, when the balance of the loan was $175,000, he refinanced his mortgage to pay off the $175,000 original loan, plus to get $25,000 of cash out. He used that $25,000 to pay off his car loan. So that means his qualified principal residence indebtedness, he has a $200,000 mortgage still, but his qualified principal residence indebtedness is only $175,000. So if he were to now
be foreclosed on or abandon that house while he's still got a $200,000 loan, and the lender was to accept that house as full payment for that loan, he would not have $200,000 of debt forgiveness income. $175,000 of that would be excluded, but he would have $25,000 of debt forgiveness income because that extra $25,000 was used to pay off his car loan, not to buy or improve the house. Installment sales. So this is going to be for any type of property. We're moving on from simply things involving the house, but for any type of property. If you sold property at a gain and will receive a payment, one or more payments in a tax year after the year of sale, then you report it as an installment sale. Part of the gain will be recognized in each year one or more payments are received rather than all in the year of sale. So a couple of things. This does not apply to sales of stocks and securities that are traded on an exchange. And you can elect out of this treatment. So you can say, instead of recognizing part of the sale each year a payment is received, I would rather just recognize it all this year in the year of the sale. You can do that. You can elect out of it. And also, this only applies to gains. It does not apply to losses. So if you have a loss, you can take the entire loss in the year of sale. You report these sales on a form 6252, and you file that form each year in which payments are received. So if you have an installment sale, part of each payment received will be treated as a return of your basis, part will be treated as interest, and part will be treated as a gain on sale. The gain on sale portion is determined by multiplying the gross profit percentage by the amount of the payment. The gross profit percentage is determined when the sales take place, and it's applied to each payment. So, for example, you sell property at a contract price of $6,000 and your gross profit is $1,500. That means your gross profit percentage is 25%. It's the gross profit of $1,500 divided by the sales price of $6,000. That's 25%. After subtracting interest, 25% of each payment you receive as part of that installment sale will be income. So this installment sale could take place over 2 years, 3 years, 4 years, 5 years. Doesn't matter. For each payment you receive, 25% of that payment will be considered gross profit. Part of that payment will also be considered interest, and part of it will be considered a return of your basis, the return of your purchase price or cost of that asset. You don't need to know, by the way, how to compute the amount of interest. That will not be tested. Just know that part of it will be considered interest. Like-kind exchanges are Section 1031, so you'll often hear this referred to as a Section 1031 exchange. If you trade business or investment real property solely for other business or investment real property of a like kind, you do not pay tax on any gain or deduct any loss from the trade. It's called a Section 1031 exchange. You report this on Form 8824 and on Schedule D. So this is business property or investment property, and it is only real property. So let's look at all of the criteria for this. First, it must be business or investment property, not personal use property. Secondly, it must be real property. This was not always the case. There was a time when you could do this with other business property, such as machinery and equipment, but not anymore. It must be real property. The property that you are exchanging it for must be like kind. But the good news is real estate for real estate will be considered like kind as long as they're both in the United States. So if you are trading, let's say you have a piece of land, you can do a like kind exchange with any type of real estate. So maybe you exchange your piece of land for somebody else's warehouse that they have. That's fine. That will be considered like kind. The next criteria is the property must not be held for real resale. So if you're a home builder and you've built a subdivision worth of homes that you own and that you are selling, and you exchange that subdivision for other property, that does not qualify as a like-kind exchange because the property that you have is being held for resale because you're a home builder. So that would not qualify. Next, the property to be received must be identified within 45 days after the date you transfer the property given up. So what might happen is you might agree, hey, we're going to exchange property, and maybe the other person has several different parcels of property, and you haven't actually decided yet which of those several pieces of property that you're going to exchange. That's okay, but you have to decide, you have to identify which piece of property it's going to be within 45 days of the day that you transfer your property. And the property that you receive in exchange must be received by the earlier of the 180th day, or about 6 months, but we have to look not at months, but at days, the 180th day after the date you transfer the property given up, or, so it's the earlier of these two dates, or the due date, including extensions of your tax return for the year in which the transfer of property given up occurs. So just remember that. Has to be identified within 45 days, has to be received within 180 days, or the due date of the tax return if that is earlier. So like-kind exchange has to meet all of those criteria. It is possible to have an exchange that is partially taxable and partially non-taxable. That could happen if you receive money or not like-kind property in addition to the like-kind property. You will pay tax on the gain up to the amount of the cash and the fair market value of the not like-kind property received. So you will sometimes hear this, the cash and not like-kind property, that will be referred to as boot, B-O-O-T, boot. I don't know why, but that's what they call it. So if you receive boot in addition to the like-kind property, then you will pay tax on the gain from the disposition of your property up to the amount of that boot that was received. If you pay money in addition to giving up like-kind property, as long as those 6 conditions were met, then it is still a non-taxable trade and you don't have any tax consequences. Involuntary conversions are section 1033. An involuntary conversion of property occurs when your property is destroyed, stolen, condemned, or disposed of under a threat of condemnation, and you receive other property or money in payment, such as an insurance or a condemnation award. This is treated as a sale, and a gain or loss is generally recognized in the year it was realized. And you determine the gain or loss just like you probably think you would. You take the amount that you received. So if you got insurance money, you take the amount of insurance money that you received minus your basis in that property. That is your gain or loss. The net payment, so like the insurance proceeds, if you had to hire a lawyer in order to get the insurance company to pay up, then you get to deduct your legal fees from that insurance proceeds in order to determine what the net proceeds were. So that's the general rule, is that you're going to have a gain or loss. However, it is possible to postpone that gain if you receive or purchase a replacement property within the replacement period. So you have an involuntary conversion. If you replace that property within the replacement period, then you don't have to pay the gain on that property. Most property, the replacement period for most property is 2 years. So that's the main number you want to remember. Replacement period for condemned or involuntarily converted property is 2 years. But there's a couple of exceptions. It's 3 years for real property used in a trade or business or held for investment. So if it's real property used in a trade or business, held for investment, instead of 2 years, it is 3-year replacement property. If it is your main home and it was in a federal disaster area, then the replacement period is 4 years. And similarly, if it is livestock in an area eligible for federal assistance, then it is 4 years. So the general rule is 2 years. There are 3 exceptions to that rule. The first one is real property used in a trade or business. It's 3 years. Main home in a federal disaster area, 4 years. Livestock in a area eligible for federal assistance, 4 years. Remember, losses on personal use assets are not allowed. There is an exception for casualty or theft losses in a federally declared disaster area, which we will talk more about in more detail in a future video. But for now, just know you've reduced the loss by $100, and then you can deduct what remains to the extent that it exceeds 10% of your adjusted gross income. That's a casualty or theft loss. For certain major disasters, you don't have that 10% of AGI floor. Here, you reduce the loss by $500, and then you can deduct the rest without regard to what your adjusted gross income is, and you can deduct it even if you do not itemize deductions. Condemnations. So a condemnation is the legal taking of private property by a government body for public use without the owner's consent. This is a type of involuntary conversion, a type of 1033 transaction. Property sold under a threat of condemnation also qualifies. So if this is your personal residence, so a condemnation, the classic example is the state is going to build a highway and they are going to condemn all of the property that is in the path of the new highway. When they condemn it, they don't just get to take it. They are required to pay the property owners the fair market value of their property. So that's what we're talking about here. If this is your personal residence, then you can exclude, just like any other sale of your personal residence, you can exclude up to $250,000 of that, or $500,000 if you're married filing jointly. Condemnation is an unforeseeable event. So remember when we talked about partial exclusions, one of the criteria was if you had an unforeseeable event, that this qualifies for that, which means you could potentially, even if you don't meet the full requirements to exclude the gain, you can get a partial exclusion, as discussed. For any type of condemned property, you can postpone the gain by buying a replacement property within the replacement period. So this is what we talked about for other types of involuntary conversions. If you replace the property, so if you have a condemnation that happens in 2023 and you go out and you buy a property, remember it's within 2 years. So if you buy a new property in 2024, then you don't have to pay any tax on the gain from that condemnation because you replaced that property within the replacement period. And that, my friends, is the last topic in video 3. I will see you on video 4.